the banks of uncertainty, this uncharted river of doubt. Fresh off a remarkable presidency, but followed by the sting of a failed re-election bid, Teddy is looking for a new adventure. He's bracing for the unknown. He knows that the path forward promises both mystery and challenge, but he's bracing the unknown with one of his sons. He understands that treacherous rapids are ahead, swift currents, indigenous cannibalistic tribes, buzzing pests full of malaria and disease, and untold murky depths below him. Roosevelt is concerned. He's concerned for his own son's health and his own family's health. In many ways, his daring expedition mirrors our journey forward. See, Roosevelt's unyielding spirit leads him that the journey must go on. And in many ways, our journey is the same. We face very interesting times. We together have sailed through prosperous times. We have navigated COVID-19 and setbacks, but we stare at our own river of doubt. Just like the vast Amazon, there is an unpredictable tensions globally that are buzzing. There are churning global trade conflicts, as well as overheated sectors. But the journey must go on. We have the discovery and thirst for progress that fueled Teddy. So as we embark on this outlook today, I understand that strategies and diligence is what it will take for us to navigate the river of doubt. So ladies and gentlemen, welcome to the state of the market. We have a lot to jump into today, and I would be remiss if I didn't talk about some disclosures and covering our tail feathers. I can't give you personal advice today. That's just not the setting. It'll take Brandon, myself, and other advisors on a one-on-one basis to unpack what this means in your situation, your family's financial situation, and how we go forward. But I do want to give you our outlook as a company on the markets and the economy. And this is one of those events that we do every 6 months that I'm excited to do because we set aside time to have a fireside chat. And we break this event into 4 major categories. What we're going to do, number 1, is talk about what brought us here. How did we get here? We're going to talk about what's driving this market performance. We're going to talk about what may lie ahead in the future, what my crystal ball says is going to happen over the next 6 months. And of course, I think the most important part, what are the offensive actions that we are taking to take advantage of these turbulent times? So let's jump right into what we have come off of last year, a fantastic year. Since 2022's down year, we've had 2 really good years in the market. 23% is what the S&P 500 did last year. So it feels like we're hanging on to the side of a SpaceX rocket. And starting with how the year progressed in 2024, that's exactly what happened. We saw one of the first in 50 years or more a U.S. aircraft landing on the lunar surface. Pretty cool point in history once again. We see Putin's re-election. People love him so much that he had that 87% vote. Such a swell guy. And then we had an assassination attempt on a former president. We had Joe Biden's withdrawal. We had Hurricane Milton, which devastated the southeast of our country with 44 tornadoes, 32 people killed. And then we had Donald Trump elected for the second time, which hasn't happened since Grover Cleveland. So to serve those 2 terms hasn't been seen in such time. But we have had some really great returns over the last 6 years. The last downtime was in 2022, but the average, what we've seen for the last 30 years, is a 10% return. And so we can see that the market has performed very well. And so we've seen above average returns, which stirs at times some complacency. But I don't want to forget to talk about the individual value investment styles that are out there. There is growth and value. So growth stocks are typically those that have, again, less dividends, higher appreciation, while value stocks typically have more dividends and less appreciation. And what we've witnessed and we've seen is that, again, a value stock is typically going to do well in a recovery-like period of time. They do really well when interest rates are going up in a rising environment. And then you can see that growth, oftentimes when interest rates go down below 4%, growth stocks do really well because, again, money is cheaper and those growth earnings grow that much faster. So we've been oscillating between the two in our portfolios and making sure that we have exposure to both of them. But we have been making some changes to that, which I'll unpack on the offensive actions we've been taking. Now, if we look at the market's performance as a whole, you can see that 23% return, but it hasn't been equal and it hasn't been equitable. Some sectors have done a lot better. Some are overvalued in some regards. If you look at technology at 35%, consumer services at 39% growth, while on the opposite spectrum, we saw materials actually lose 2%. So we're keeping a close eye because back to our conversation about growth and value, value stocks are typically things like industrial and real estate and energy, those that have the higher dividends, while growth typically is going to be those communication services. They're going to be technology, those that have high appreciation but very little dividends passed on to you as a retiree. Now, we enjoyed these all-time highs. We saw over 50 all-time highs happen in 2024, where the market just continually, steadily went up and up and up. But sadly, families are using that as a reason not to be invested. Oftentimes, people will cite an all-time high as a reason not to be invested because if the market's at all-time highs, it might go down. And the concern that I would have for those families is you don't want to be left behind because typically all-time highs, what we've tracked in history, is that they're oftentimes clustered together. So all-time highs doesn't mean that it's an exit sign to leave, but it's a time to reevaluate. And what we are really looking at is the valuation of these markets, not that they just hit all-time highs. Now, I love this chart. I think this is one of the better visuals I'll have for you today. What I'm showing you here is over the last 100 years, the market has made roughly 11%. And oftentimes we worry about what happens on this far left area. So this area where you can see the negative returns. 73% of the time, the market is positive. We actually can see some great and really good returns, all of these stacked up in the green, but sadly we focus and we spend 8 to 12% of the time, we're spending time focusing on these that happen right here. So we want to make sure that we give you that voice of reason that helps you to understand that 73% of the time the market is going to be positive. And that means that we must not try to time the market, but have time in the market. What this does allow us to do when we see all of these market highs happening over and over again, it's a time to reevaluate. It's a time to say, hey, should I rebalance my 401k? Should I take this time to make sure that I have only money I'm going to need for the next 3 to 5 years in the walls and the foundation? You probably are familiar with our language of roof are more market-related investments. Well, if you're going to be touching any income from investments in your roof for the next 3 to 5 years, you're going to want to make sure that you're very diversified and have lowered the risk. Because typically money in the market is designed to stay there for 3 to 5 years. Now, what is driving all of this market behavior? What is the reason why we've seen such strong returns in the S&P 500, especially for the last 2 years? Well, if we pull back the hood, these are some of the economic pistons that are underneath that economy hood. So you can see here that some of the things that we've really enjoyed lately is low unemployment. And so when we have low employment, everyone's working, everyone has readily cash to spend, and that is pretty fantastic to see families spending confidently. We also have really enjoyed a market that keeps on going up, and we've also got our eye on the red speedometers. So as you can see, green is good, yellow is reason for caution, and red is reason for concern. So we're keeping a close eye on trade tensions and those decisions that are being made in this new administration. And we're also keeping a very close eye on equity market valuation. So if you look at this dial right here at the bottom right, that equity market valuation, if you look at some of the main thermometers that we use to determine if the market is overvalued, you will see that it is absolutely overvalued based on the Shiller PE ratio, based on the Buffett indicator, and many more indices are telling us that the market is overvalued. So we have to tread carefully. One of the things that's driving market behavior is the AI revolution, because it stands as the software and the operating system for robotics and drone technologies to come in the future, and the adoption of those technologies. And luckily, the US is leading the charge. If you look at our 5,400 data centers, in the next 10 or so countries at 3,800 or 3,400, we're by leaps and strides above our competition with our other countries in leading the charge towards AI. But we will have copycats and small companies that rise up and they bud like DeepSeek that are going to challenge some of our main competitors, the main benefactors of AI that we call the Mag 7. And I think that's a good thing. We need to be humbled here in the United States, that just because we have all these data centers, that people are thinking more cleverly and how to do it for less cost. So AI is going to continue to be the future, just like the internet was going to be the future. Never as fast as an adoption as maybe people think initially, but over time, it's going to make a major shift throughout the environment for companies. And so I think it's important to step back and say, how can we think 2 to 3 steps ahead? Well, if we're going to have more AI, we're going to have more drones, we're going to have more robotics in the future to come, what powers that is energy. And so we are very long and are betting and very bullish on energy's future, which I'm going to talk about our Swan Nest Fund and how that incorporates that desire to not miss this opportunity, because we're going to need more technology. What I can tell you is right now, our power grid, those 5,400 data centers represent only 4.5% of our electrical grid. By just 2030, it's going to be 12.5% of our electrical grid. And so we have to start preparing for that immediately. And again, a lot of people have different opinions about this. And I read a very good book on this recently that talked about that renewables are great. It's not that we need different energy, we need more energy. Just like you're still burning wood at home, it's not like we got rid of wood. I actually have a client that is one of those manufacturers of wood pellets that we sell to the UK and other countries. They're still burning wood for energy. We also incorporated coal, then we had oil, and then we had nuclear. And we're going to have to continue with things like liquid natural gas and all of these other options. Why? Because we don't need different energy, we're going to need more. The other thing that's really powering market behaviors right now is the Mag 7. And this is one of the reasons for concern, is right now, if you look at the S&P performance for the year of 2024, and you strip out the Magnificent Seven, those 7 companies like Google, Tesla, NVIDIA, Apple, those companies, you rip them out of the S&P 500, the market would have not been up 23%. It would have only been up 10%. But go back to 2022 and look at how interesting this is, that when the market goes down 8% minus the Magnificent Seven went down 40%. That's a 5-6 time delta. So if you're in the S&P 500, you're in those stocks, you need to understand the amount of risk that you're taking. That in just 1 year, when the market would have went down 8%, those holdings went down 40%. And the reason I want to give you some historical context is right now, those 7 companies represent 38% of the S&P 500. In the 1990s, the late 1990s, the epic time of irrational exuberance before the dot-com crash, the top 10 holdings represented 28% of the S&P 500. The top 10 companies represented 28%, while today the top 7 represent 38%. So what you're seeing is a concentration into those 7 companies, which is a self-fulfilling prophecy until a dynasty is broken. And so it's very important to make sure that you're properly diversified. The other thing that we've seen powering this economy is, of course, our very resilient GDP. So you can see in 2020, we had negative GDP when COVID-19 outbreak happened, and we had to put the worldwide economy on pause. And then we saw surging GDP come back in 2021 when everything started to open back up. And then in 2022, things were still unsettled. We actually had a negative GDP quarter within that year. So things were still shaking out. And then we saw in 23, it stabilized. But what's interesting is in 2024, you can see that we stabilized and dropped. So the focus of this administration, this new administration, and all economists will be on the eyes will be on future GDP. It is what's powering our economy is our consumer spending. And here's what we need to realize is with GDP being 70% made up of consumption, if you start having bumps in the road, that is going to, of course, affect the markets, because right now the Buffett indicator, which compares our GDP as a country compared to our stock market, we're right now 208% over our skis, meaning the GDP is behind how overvalued our market is. We're 2 standard deviations above our GDP, and that is room for concern. So that's why we're keeping a very close eye and starting to diversify even further, starting to lower your risk in your roof accounts, which we'll talk about shortly enough. Now, with the rate cuts, of course, we saw our first rate cut. That obviously is what the market analysts wanted to see. They wanted to see cheaper money. When cheaper money is available, corporate growth continues forward because we can borrow cheap money to continue to grow operations. Now, generally, when the market gets its first rate cut, the market continues forward. But this rate cut does seem very differently. It feels different as well. And the Fed has 2 very important dual mandates. They are looking at unemployment, and they're also looking at inflation. So we've seen inflation permeate down to its very fine granular details of home insurance and auto insurance. So it's not that, again, inflation's gone away with or we have deflation. We just have less inflation growth as before, but we still have had a lot of inflation, as y'all all know, that's permeated the economy. So the Fed's keeping a close eye on that, and its dual mandate is looking at the unemployment numbers. Well, the unemployment numbers are very stubbornly low, which is what it keeps the Fed from lowering interest rates. If we see more interest rates drops, that's of course going to help us with corporate growth, but also real estate as well. Now, what does the future hold? This is one of those slides we have every state of the market, because these are some of the brightest minds. These are the analysts that are all saying in unison, they've all got on the bandwagon that the market is going to go up this year. And what we've also found by having this every state of the market, every halftime report, is that they're very wrong most of the time. And sadly, I'm not a better predictor either. These are some of the greatest minds. They're telling you at Wells Fargo and Deutsche Bank that the market is going to hit as high as 7,000 this year, is their prediction. But there's a lot that has to happen for this economy to keep on going forward. And so this is, again, a reason why we have made so much offensive action in preparation in case it doesn't. So we can expect more volatility. It's not going to be a straight shot to 7,000. I love this graph because it's very simply putting that you need to expect volatility, especially coming off two 20% years in the S&P 500. If you look, 91% of the time, the market is going to have an intra-year swing of 5%. It's going to have 55% double digits, and 32% of the time, it's going to swing 15%. And again, my prediction, for what it's worth, I lean towards is going to be closer to that 32% of the time. I predict that we'll probably see some very big intra-year swings, most likely, as it shakes out with a new administration, new geopolitical conflicts, sadly, as well as trade tensions. So we need to be prepared, and that's what Lucas, our portfolio manager, has been doing. We have over $20 million of readily cash within the portfolio, just sitting there in stocks within some of the portfolios. We also have been able to downshift in preparation for some of this volatility. And so if that starts happening, you're going to see us start making a march towards taking advantage of this volatility as it occurs. Now, if we put our bull run in perspective, we conceptualize where we are. Since 2022, the markets went up 70%. That's where we are right there with the red right here. And as you can see, the average bull market can last as long as 5 years. So we're 2 years into it, and people are saying, hey, the market's really hitting some all-time highs. It could continue because it can go as long as 5 years on average and go up 190%. So we still have plenty of runway where this market continue to go forward. Now, with the new administration, there are, of course, going to be headwinds and tailwinds that we have to deal with appropriately. The first one, of course, is why the market responded very positively in the fourth quarter, is they're expecting and predicting that we will see lower regulations. And as a business owner, that is a good thing. We probably have gone a little too far one way to too much regulations. I'm all for saving the whales, keeping everything clean, but we have to make sure that business can still push forward. But you also are expecting a market that is predicting that we will get tax cuts extended or additional tax cuts. And again, I think that is very hopeful at best. And I think that's a good negotiation tactic to start with the idea of less taxes, but it'd be great if we could just settle with the same taxes, which I'll talk about on the offensive, how we're taking advantage of that. So obviously, we're riding a lot of stock market optimism with those two factors, in addition to the AI implementation and the benefactors of AI within the Magnificent Seven. Of course, there's going to be headwinds. We're going to have more trade discussions and all-out street fights. And I have to remind people that we can be the last one standing. We're a very strong, resilient country. But when you get in a street fight, you're going to have bruises and cuts. So we're going to try to hopefully avoid those when possible. The second thing is deficit concerns. I'm going to show you a slide in just a second that tells you that this is a very serious issue. And we've said that over and over again, but we're coming to a point where we're going to have to start making some hard calls. And so when you see this Doge and less federal workers, that's going to have an effect. And it's going to have an effect on the job market. My prediction, though, is that's actually a good thing for Mr. Trump, because he's probably expecting that if he lets go these federal workers, that will increase unemployment. And what will the Fed do? Hopefully, he's predicting, and that is a bet to very carefully make, is that the Fed, with that dual mandate, would lower interest rates. The only problem is if you use that lever of lower interest rates and we get into something harsher, like a deep recession, a depression, and you've already used that lever and you haven't pulled back the emergency raft of lower interest rates, you have not many other tools in your tool belt to utilize. The other thing is the job market. We need to talk about mass deportations could potentially lower crime, but that also has unemployment situations that we have to deal with. Now we have less people doing the laborious work that we don't want to do. So there's going to be a lot of churn in the job market. This is the graph I was foreshadowing. Doge is focusing on this Top 12% mostly, non-defense discretionary spending. That's 12% of the budget. Defense, we need to have some tough conversations. As someone that is very proud of the military presence that we have in this community, I know that's on everyone's sleeve, but that's a big budgetary item. It's bigger than what they're talking about. This is what everyone is trying to avoid talking about so they can get reelected. But we're going to have to start making some tough decisions. Someone's eventually going to have to be the bad guy with Social Security and Medicare, because you can see the situation that we find ourselves in. This on the right side is our source of funding. And we can, again, increase payroll taxes, we increase income taxes, but this is our massive deficit. And what you should all be concerned about, I am, is this net interest is now 15% of our government spending. That is only going to increase as this problem doesn't get solved. So what I'd love to see is from our politicians, I wish they would do this, I would hope they would do this, but unfortunately on both aisles, they're not very smart. They're going to wait till the very last minute to deal with Social Security and Medicare. What we don't want to wait for is what Lucas, his home country, experienced with riots about decisions made at the last minute, or worse, they make complex changes that none of us can follow. What we need to see is from 40 and below, because those individuals are not even thinking about retirement, start increasing the retirement age from 65 to 65, 70, and then 72. Some of those incremental changes, if we started to make them now, would save us from this massive issue that we have with Social Security and Medicare. The uncertain job market. Again, we're experiencing low unemployment. We've experienced really nice wage growth in the previous years after COVID. But again, we have very low inflation, which means the Fed is not in a rush to act to change interest rates. But as we have tough conversations about federal employment, again, I'm on a chat room, a Facebook group with federal employees about how many will be exiting. And it'll be very interesting in the next 5 to 6 days how many are going to take advantage of that looming deadline to resign. And then there are going to be risks where they are actually pushed out of federal workforce. We're going to see continuation of mass deportations. And what does that mean? None of us know, because some of these are unprecedented. So how that will affect the job market is yet to be seen. So let's talk about what we're doing in our personal economies to take advantage of these larger points in our economy and volatility that we can take advantage of. So the first thing that we can do is just by rebalancing. It's fundamental for a good reason, because it works. It does 2 or 3 things very well. One, it helps us when the market is manic depressive. When the market thinks that everything is overpriced, this is one of the better times to rebalance and sell some of those winners and buy some of those losers, because they won't stay losers forever. The second thing it does is by rebalancing, it creates cash. So for when clients are taking income from their investments, it allows us to have some accessible cash to pay out distributions. And then the other thing it makes sure is just stability, and making sure that when we see these big dips in the market, that we can take advantage of that instability. So these are some of the changes that we've made throughout the year. You get a quarterly rebalance email where we tell you that part of the dust of the changes that we're making, we were able to lower a little bit of our technology exposure in Swan Aggressive, beef up a little bit of the value, because value is very undervalued compared to the growth. We also beefed up a little bit on international. International has been a decade plus long underperformer, but international will have its time again. The domestic value is very overvalued compared to the international market. So we made sure that we have good exposure to value and growth, as well as large, medium, and small. The other thing that we've done very successfully, and I'm very proud about, is inside your roof accounts, those accounts that are connected to the market, the 4 major portfolios that we manage, we were able to downshift, meaning step slowly as we hit new all-time highs and move clients down an entire 1 year. Meaning if you were in Swan Aggressive, we were able to move you to Swan Growth. And this allows us, when we see one of those intra-year swings of 15% or more down, to step into it. Instead of downshifting and backpedaling, we can start running into the storm because we've been making preparations this whole time. And so tactical downshifting is a very good strategy. And I want to highlight the importance. Again, it's not trying to time the market. It's about staying in the market the entire time, but choosing wisely how much we allocate to the market, which is a good segue to our roof, walls, and foundational accounts. Now, many of the newer clients may not have experienced it, but for the last 2 years, many of your wall accounts have made 5, 7, 10% consecutively over the last 2 years. And locking in 2 years of 10% is very handy, so that when the market does drop, we're able to shift money from the walls into the roof. And that's what we've been doing. That's why we're building a storehouse of dry gunpowder, that cash in SNOX, our money market, in preparation for a market pullback, to put that cash to good use. So while 4% in a market, we're on standby with that cash to deploy it within the roof accounts. Tax diversification. One of the biggest pats on my back I'll give our team is that we have been able to shift and migrate $100 million of clients' assets to tax-free investments. We expected that if the election went a different way, that 2026 was the deadline for tax rates to go higher. The Trump tax cuts would have expired in 2026. Mr. Trump is going to try to extend those tax rates. So that gives us a longer window of opportunity to take advantage of this very low tax brackets that we have experienced. Like right now, the current top marginal tax bracket is 37%. But as you can see, compared to history, it's been 54%. It's been 90% 14 times in US history. So if we can't fix that federal deficit problem, they're going to start saying, well, we're just going back to some of the averages in the past. And that we want to prepare for, because if you have money in 401ks and IRAs, that money has never been taxed. So we are going to continue by taking some of your balances in your IRAs over a 4 or 5 year window, dividing that balance and trying to get as much as we can in that window of opportunity, since we have a longer runway with taxes. The other very important step that we've made to prepare for a market pullback is bringing into consideration alternatives. This is something we all need to know, is that success leaves clues with investing. If you look at the sovereign wealth fund of various countries, like the Cherokee Indians, for example, or CalPERS, the pension funds, Yale Endowment, a family office that has a minimum investment of a family of $100 million, they're not investing in just this 60-40 portfolio. They're not investing in just bonds and stocks. No, they're integrating, on average, 27 to 30% in alternative investments. Things like real estate, private equity, hedge funds, direct lending, infrastructure investing. Why? Because you can see right here is the volatility, the annualized volatility at the bottom, and you can see the annualized returns. So you can see that a portfolio that has 30% alternatives and it has 20% in bonds or wall accounts actually has higher returns and the same volatility. And that's why you've heard us talk extensively of the importance of adding Signet to your portfolio. For those who are accredited investors that have $1 million of net worth excluding your home, or $2 million excluding your home, we've been able to incorporate Signet, which is providing us a different uncorrelated asset from the market, from that general 60-40% that's in stocks and bonds. Now, what I'm very excited about introducing you to in 2025 is our Swan Nest Fund. We believe that there is going to be more demand for energy. And as that demand for energy continues to increase over the next decade, and our electrical grid starts to get swamped by all those electrical vehicles, as well as all those data centers, we're going to need more energy. And so what we're doing is aligning ourselves with operators in the energy, not wildcatting for oil, but aligning ourselves with operators that can go behind Exxon and these major oil companies and do horizontal drilling, as well as drilling and opportunities that just are not enough for Exxon to stay, and they can move on where a smaller driller can come in and take advantage of it. We're also not neglecting private credit and private lending. Since 2008, these are some of the largest asset class growths we've seen is in private credit and private lending. And the reason why is banks, very restrictive, only matches my checkbox where I can make a loan to a company. Things like litigation finance and tax lien funds. This is where private credit and private lending provide us dividends that we cannot get anywhere else, that provides income to you as a retiree. So you will see us produce a webinar very shortly talking about the Swan Nest Fund in 2025. I do want to give you an update on Signet. Again, we create a new vintage of Signet, our real estate fund, every year. And this is one of the properties in 2023, for example, that you can see that we were able to renovate 144 units already in this apartment complex. And that has actually increased rents by $433, which is amazing to see. So if you want to have more information about Signet, there's a webinar on that QR code, or Lucas or I can send you a copy of that webinar. For those invested in Signet Fund 2024, I want to play this quick video for you and share with you one of the properties that we just invested in. So we do a new vintage of Signet every year. So you'll hear about Signet 2025 and the 30 plus properties we'll invest in Signet 2025. So some of the actions that we've been taking as a recap is rebalancing, tactical downshifting, Roth conversions, as well as making sure integrating things like Swan Nest that are going to provide us a different uncorrelated asset, incorporating things like Signet, where real estate has a different reaction to economic news and economic drivers. This is why we have created those alternative funds to prepare us, along with all those other activities, for anything that lies ahead. I do want to give you some updates on taxes. Of course, the government thought it'd be a great idea to make it more complicated to contribute to your 401k and IRA by creating this opportunity that they thought was a good idea of this catch-up provision. If you're over the age of 50, you're allowed to do an additional catch-up to your IRA or your 401k, but they created another catch-up opportunity for those who are 60 and 63 randomly. I guess there was enough congressmen and women that thought that they needed to be able to put more in their accounts. I don't know who they consulted for that, but now you can put, as you can see, $11,250. Scott was here at the Pensacola State of the Market, but at this State of the Market, I want to tell you that if you have not had your legal documents reviewed in more than 3 to 5 years, it's time to blow the dust off them and have them reviewed. If you've had a life event, then it's important to make sure you've updated your legal documents. If you have a home that's owned in Florida, for example, you may want to consider a life estate. Make sure that you're home titling. I see this sadly too often where a home is owned jointly and it is not positioned in a life estate or a trust, and that can be a probatable asset for a family. One of their largest assets, sadly, will go through probate. I'm very proud of the team's desire and devotion to continued learning. Lucas completed his CFA, which is the hardest designation in finance you can get. It's the equivalent to like 3 bar exams. To put it in perspective, it's 3 different tests. We've had Therese and Jacob put in the time to get additional designations as paraplanners. The team is growing. We have new faces, and the team continually gets better. But there are going to be growing pains, and I want to hear directly from you if we drop the ball in any way, because they're still learning. But they're also really devoted to their education, and I appreciate that in a big way, because we created this continuation learning tracker for each of them to get better. So you had some time before the presentation